The reason you use private lenders is that game doesn't exist for private lenders because it's a relationship. I know you build a relationship with hard money lenders, but you don't build a relationship with an institutional hard money lender like you build a relationship with your neighbors, your coworkers, your friends, your family, and all the people on here. That relationship pays massive dividends. And once you build the relationship, you've got somebody that will continue to keep lending regardless of market conditions, regardless of what their hedge fund backer of the hard money lender tells them, well, we can't give you this. So they change the rules. What's up, everybody? It is another week of Wealth Webinar, and today we're going to do something that I'm not used to doing. We are just going to talk because technology sucks and computers suck and nothing works. So we're going to try this a whole different way using old-fashioned paper files. We're going to try this using a whole bunch of deals that are all in 3-ring binders, and I'll kind of try to piece it together without drawing it. But what I wanted to cover, what we really wanted to cover today is, and I'm going to change it up now that we've got so many lenders on here. We're going to talk about private lending and we're going to talk about borrowing, but we're going to talk about other ways you can do it more effectively and more efficiently. So first off, let's go into the audience real quick and let's just see, where is everybody lending money from? How many of you are lending from a self-directed IRA? In the chat, put SDIRA. I want to see how many of you are doing self-directed IRAs. And if any of you don't know what an SDIRA is, it's a self-directed IRA. In other words, these folks that are saying SDIRA right now in the chat would have been people that, had a job, maybe had an old 401k, an old 403b, maybe a 457 if they were government employees. They've either left that employer or they've retired. So they have that money sitting there and they just rolled it over to an IRA, but instead of just a traditional IRA, they rolled it into a self-directed IRA, which allows them to then lend money from their IRA. You can do all sorts of really cool things, because if you understand a retirement account, I don't care if it's a 401k or an IRA, you can hold the investments that they allow you to hold. So if you had a Schwab IRA, you could buy mutual funds, you could buy ETFs, maybe you could buy individual stocks if your profile was set up for that. Heck, you might even be able to trade derivatives options. It just depends on how your account was set up. But the one thing you wouldn't be able to do is buy physical gold. Another thing you wouldn't be able to do is invest. You couldn't take your money in your Schwab IRA and invest in a private syndication, or you lend money on private money club. They wouldn't allow you to do that. They actually wouldn't even have a clue what the heck you're talking about, because it's outside of the realm of traditional investments. So when we talk about self-directed IRAs, all they did is they just changed where the money went, and it went to a custodian that allows them to do pretty much anything you can think of. They can still buy stocks, they can still do anything, but they can buy gold, they can invest in real estate, they can do private lending. So we got a whole bunch of people that have either, oh, that's cool. Paul's got a self-directed Roth 401k, commonly known as a solo K. They go by lots of different names. We got a couple other people here that have solo 401ks. So that's just like your 401k that you have at work, except for you're a sole proprietor. You're the only operator of your company, and you opened up a self-directed solo K. So that gives you the ability to do that. And we've done lots of trainings. Now, IRAs, you've heard them come in a lot of different names. You got Roth IRAs, traditional IRAs, simple IRAs. If you're a small business, maybe you set up a simple IRA for your employees, which allows you to put a little bit more money into the IRA than a traditional or a Roth. You can put higher contributions, but now you got to typically match 2 to 3% to the employees that participate in that. But a lot of times people that have simple IRAs, their employees don't want to participate because they're real small businesses. You got SEPs, I wouldn't say it's an IRA, it's a simplified employee pension. So you got all these different retirement accounts out there, and I'm just seeing some people putting stuff in about those. I don't want you to get confused with all of them, because really they're pretty much all the same, except for the tax treatment and the amount of contributions. And every one of those, from simples to SEPs to Roths to traditionals, all could be self-directed, meaning you could move them over to a company like Horizon Trust, and then you could do everything that we're about to talk about, which would be private lending and all sorts of alternative investments. And by the way, folks, is anyone on here right now trading stocks? Do we have any stock traders? because you could do that with your self-directed. But is anyone right now trading stocks, or is everybody just steering clear of stocks, which would be probably the smartest thing you can do? So Anonymous was asking, is there an age limit for self-directed IRAs? Not necessarily. I mean, I think you got to be, what do you got to be, Steven? 16 or is it 17 to open one? Or actually, you can do it younger than that now, right? Like, how old do you have to be?
No, I mean, a parent can open one. You have to have an earned income though. So the child would have to be like on a company payroll where they're paying them something.
So 7 years old would be the minimum then, because that's the earliest you can pay your children. I just did an Instagram video about that. So 7 years old would be the earliest. And also, folks, if you have kids, I'll throw a little piece of info. If you got a business and you have children between 7 and 22, put them on the payroll. Put them on your payroll. You can pay them. I might get it off a little bit. It's a little over 13,000 for 2023. And that income to your child is tax free. Yes, you have some taxes you have to pay on the business side, but tax free to them. And then from there, you can do whatever you want. So that's a good way to do that. So hopefully that helps you, Anonymous. To let you know that you're 7 years old would be the minimum. The maximum, you got minimum RMDs at 70. So I would say that's probably about the most you'd ever want to wait. So, and if somebody's 70 and still contributing to an IRA, I'd have to ask why, because you're going to be forced to take that money out unless it's a Roth. And then Roth IRAs are great, but Roth IRAs have pretty low phase out limits, meaning if you're making a certain income or you're over a certain income, they're going to phase you out. They're not going to let you contribute to a Roth IRA. Now that's different for a Roth solo K. So the rules are very different. Again, don't try to be an expert in all these things. Just get on the call with Horizon Trust for that. So I know we went a little bit longer on the IRA side, but let's get back. So we got a couple of people here. I want to hit the stocks real quick. So we got Mark's trading stocks. Chris M is shorting the market heavily. Very smart. Aaron's doing options. Options are pretty tricky right now, aren't they, Aaron? You doing well with options? Because and with the market volatility, the up, down, the sideways moves, I mean, you got to be pretty nimble in options trading. So I would say if you're going to do any kind of options tradings or option trading, you should be trading just intraday. Trade only for the day, never hold overnight, because that's when you're going to get hurt in this kind of a market. But I like the people that are saying, that they're taking the short positions, probably smart. You're going to bleed a little bit for here, and so make sure you got enough margin to cover you for the next, whatever, quarter, 2 quarters, because it's going to be very choppy and volatile. And if you're short, that will bleed your margin pretty hard. I've been in a position during the pandemic where I went short real heavy on the market. Short just means you're betting against the market going up. And when the market didn't drop steeply, what happens is, every day you're losing value because of the time. Time's your worst enemy in options. And I was shorting with options. And therefore I ended up getting margin calls on a couple of things. Luckily I had the money to pad the account so they didn't close my position. So just be really, really careful with that stuff. So let's come back to private lending. I just want to make sure we hit, who are the stock traders and who are our private lenders. So here's the deal. The biggest thing I want to talk about is banking. If there's 2 businesses you should be in the world, like if there's only 2 businesses you should be in, one is the business that you're in now that pays your bills, buys your diapers, pays for those overly priced groceries, the fuel in your car, and all that good stuff. The second business that you need to learn and be in is the business of banking. R. Nelson Nash said that in his book, Becoming Your Own Banker, and it couldn't be any closer to the truth, because if you understand banking, you understand almost the entire foundation of how the money system is built, because it is all banking. Now, we can't do what banks do. We can't do what the Fed does, and we can't do what the government does. We'd all be in jail if we did exactly what the Fed and the government do, because they would call that counterfeiting. They would call that fraud, money embezzling. They'd call it everything. I mean, racketeering. You'd be thrown in jail for everything for probably multiple lifetimes if you did what the Fed did. So we can't do that. But what we can do is control where we put our money. We can control where our money goes, because you're always gonna earn money. I don't care if that's through business operations, through dividends or gains or interest earned on money, or just going out and laboring and doing your job. But when that income comes, you really, really need to focus. If you're going to focus on banking, you need to focus on where that money goes. So when you make it, most of you put it into the bank, which I get it. We all have to put it into the bank first. And then from there, the money disperses to other places. Some of it goes to entertainment, bills, debt payments, and then some of it goes to 401ks and all that stuff. But I urge you to, when we teach this a lot, and I'm not going to go deep into it today, I urge you all to really focus heavily on changing where your savings goes. the money you'd normally leave in a bank account, the money you'd put into a money market, the money, your safe money. Okay. The money that you're looking at possibly a fixed annuity for. I would urge changing where that money goes and put that into the specially designed and engineered whole life policies that we always talk about. And I got some really good news. I can't announce it yet, but I'll kind of give you a glimpse into 2023. We've been working with one of the giant insurance companies that we work with, one of the mutually owned insurance companies. They're one of the non-direct recognition ones where we can take loans and not have to, have our dividends or interest affected. But the problem with this company is we could never build them to maximize early cash value. And when I say high early cash value, is for any of you that are in private lending or real estate, if you put your money into one of these specially designed and engineered whole lives, there's a good chance you're going to want between 85 and 90%. Under the new IRS rules, the 7702 rules, like we're going to pretty much max out nowadays around 90, 92%. We used to be able to get to like 94, 95 pre 7702. But we're at 90, 92. And this company that I'm referring to, which we'll announce after I finalize a few more things with the insurance companies, we could never get over like 82 to 85 was like a good day. And that was like an avatar. But now we actually have figured it out. We've got the insurance company to basically create what we wanted them to do. It's still on an exception basis, but I did my first one yesterday. Super excited about it. My very first one was done yesterday. Over 90% immediately. But here's the coolest thing. We can get over 90% with some of our carriers, but then we sacrifice on the guaranteed column. And this new design, the guaranteed cash value and the after dividend cash value, the non-guaranteed, are so freaking close. Like they're almost identical with the way that we've designed it. I can't wait to show it to everybody because it's going to change the way we do everything with banking. So now we know that we can get somebody a rock solid plan, not sacrifice anything on the guaranteed side, not sacrifice anything on the non-direct versus direct recognition, not suffer anything in the long run growth. We nailed it. So we now have pretty much the IBC machine that will work in almost every case with one of the best companies for what we do. So just a little glimpse into the future. So that's what I'd urge you to do is watch our videos. Stephen was playing one of the videos. There's a whole bunch of them to teach you about the infinite banking concept. But the infinite banking concept in its entirety is a banking concept. It's literally like if you read the definition in Nelson's book or Google it, definition of infinite banking concept is to take back. So again, to take back the banking functions in your life. Doesn't that sound good? Imagine if all the banking that you give away to banks and to private institutions, imagine if you could do that all yourself. It's exactly what the infinite banking concept is. No money ever leaves your banking system. You never have any leakage unless you screw up and allow it to leak. Everything is a closed system. Think of Apple, right? Steve Jobs got ousted from his company and took a lot of crap early on because he wanted end-to-end control. He didn't want hackers to come in and plug things in. He didn't want them to be able to open the case and add their little gadgets to it. Hence why that computer over there doesn't work, because it's not end-to-end control. It's enough people get their hands in the cookie jar and all of a sudden the damn thing doesn't work. So what the infinite banking concept does for you is allows you to close all the holes in your money. It's probably like all your money flows just within your banking system. It starts in your banking system. It goes out to work for you wherever you're going to do it, with financing cars, financing boats, private lending, like we're going to get into. And then everything that you earn on your activities from your bank comes back to your bank. I mean, it's a circle. It's so simple. People overcomplicate it and they want to get in the weeds. And, it's an interesting conversation, but it's just a circle. Money starts on the left, moves over to the right, makes more money. That money that it makes comes back over to the left side and ends up in the same place, like end-to-end control. A circle doesn't have any breaks in it. It just continuously flows. Now, just imagine if your money just continuously flowed, but every time, like the Monopoly board, right? The Monopoly board, when you got around, when you pass go, you always got more money, right? So every time you were just trying to get your little guy, I always like the little car, but you were always trying to get your little figure around the board. Isn't that what you were doing? And along the way, you were picking up different things. You were investing the money that you got from pass and go. This is so cool. I never thought about it this way, Stephen. Have you? You ever thought about like infinite banking, like Monopoly? How many of you have ever played Monopoly? There's a lot more to the game, but really, if you just go around the board, you just keep getting more and more money. And as you go around, you either pay because you screw up, you make bad decisions, where you can make bad decisions in private lending, or you pick up properties, you pick up opportunities around the board. And you can pick up different opportunities at different price points. As you know, like when you pass go, all those properties, the light blues, those are all really inexpensive. We call them slum properties. You can lend money on slum properties. You can buy slum properties. And as you're going around and you get to the boardwalk, that was like your premier real estate. Well, it doesn't matter. One thing Monopoly doesn't teach, it always taught buying the property. But imagine if buying the property was just you lending on the property. You weren't actually owning it. You were just lending on it and you were controlling it. So I like to think of the infinite banking concept a lot like the Monopoly game, because the more times you get your money to go around that circle and land back on the left side, we'll just call that the go, right? Once you pass go, the go is once the money comes back to your policy, and then once it moves back out, there's more of it. Every time that will happen. There always will be more money in your system if you just continue to keep playing the game. So yeah, I love that. The IBC board game. I mean, it's Monopoly 101, but it wouldn't just be the IBC board game, because the IBC concept is just the concept of taking back banking functions. The private money club completes the board game, because that gives you all the opportunities of places where you can stop and your money can go to work for you. When we talk about your money sits in a lot of different places. Some of you have money in 401ks. Some of you have money in the form of equity in your house. And can I just ask a question? Is anyone, and this is the only people I want to respond to, has anyone not went out and gotten a home equity line of credit by now? Is anyone still sitting on the sidelines if you got equity in your house? Okay, Deborah, who else has not? And be honest with yourself here. Like, I know you don't want to be like, oh, I don't want to let people know that it was me. Okay, so rent. Okay, that's not. If you're renting, just ignore it. But this is if you have equity in your house. The thing we got to really get clear on is, why wouldn't you go get this? Now, I know everybody's busy. We're in the holiday season, but please do yourself a favor. Call the bank that you go to, call your credit union, call a community bank if you don't like your bank, and just start the process. Have them mail you or email you the forms to start the process for a home equity line of credit. There is zero reasons, zero, not one, unless you say to me, well, Chris, they're going to pull my credit report. Okay. If that's your reason, like, there's not much I can do to help you, but yes, you're going to take a couple point hit on your credit score, but that's okay, because you know what, if you don't do that, you're going to take a bigger credit hit on your score later anyway. Set yourself a goal. And I hate to even say it's a New Year's resolution because it's too long. Go to your bank, call your bank, and get started on getting the home equity line of credit. If you've got equity in your house, please, every day you come home to your house, if you're sitting in your house right now, look up, see the ceilings. What's beyond those ceilings? 2x4s, rafters, plywood, right? Buried in all of that is all your money. And it's just sitting there doing absolutely nothing. And as the Fed plays games with our lives, your money that's sitting in those rafters is getting weaker and weaker and weaker. Every day, that money is worth less. You got mice in your attic eating your money. And the only thing you need to do to get that is to get the damn money out of the attic. So please do yourself a favor and go get that home equity line of credit. I can't stress that enough. If you're brand new to us, you know, maybe some of you have never heard us talk. Yeah, termites eating through it. Whatever you want to figure it. I don't care if you want to think of big fat rats eating your money in your attic. Whatever's going to get you to move your ass and go get a home equity line of credit, please do that. I think that's one of the biggest mistakes in modern day times is people glorify equity in their house. It's almost like a talking point. They're out playing poker or they're out to dinner and they're talking about the value of their house. They're bragging about the value of their house. That's kind of like all these crypto people that were bragging that they just bought a Lamborghini and now it's getting repoed, or will be soon because, well, they didn't quite play the game right. So your house is going to go down in value. I hate to be the bearer of bad news, but your house is going to go down in value. So if you don't get that equity out of your house, okay, if you don't get that home equity line of credit, you are literally not going to have it anymore. I can't preface that enough. That equity will be gone, or a big chunk of it will be gone. And maybe not all of it, but a big chunk of it. Why would you want that to disappear? That equity in your house can make your family live a better life. Now let's go one step further. And I know this has nothing to do with private money, but it has everything to do with preparation for what you need to be doing. Right now, if you've got equity in your house, I want you to ask yourself a second question. Do you have credit card debt? Got any credit cards that haven't been paid off? Got any loans that haven't been paid off? How much are you paying on those loans? If they're variable rates, it's gone up. Some of you might even say, well, the rate on my home equity line went up a lot. Yeah, more than doubled. But that's okay. So did your credit cards. Get the money out of your house. Pay off all your debts. Debt will be the number one thing that sinks you going into this recession. It will be the single solitary thing that brings you and your finances to their knees. So use the equity in your house before it's gone to pay off all the debt. And when you pay off all the debt, take the money, and here's that circle. We're kind of thinking like a bank. Once you pay off all the debts, take the money you used to pay the debtors, your car payment, your credit card payments, all those, and then pay them back to the home equity line of credit. Now you're refilling it, but you've already used the money and it went out to work and you made a spread. If your credit cards were, 10% or 20% and your home equity line of credit cost you 7, just do the math. That's the spread you made. So that's really smart uses. But let's just say you don't have any debt. Now we can move on to the fun stuff. So we've got sources of money, your old retirement accounts, your new retirement account, your 401k that you can take 50,000 or 50% from, your infinite banking policy. See, you got all these sources of places where money is. Now we need to make that money work. If you're done with your debt phase, if you've paid off your debts and you're no longer worried about that, let's move on to some fun stuff. Let's become the bank by lending. Because what does a bank do? A bank gets us to deposit money there, and the bank takes our money that we deposit there and makes that money go to work in the form of loans. I had a lot of fun the other day. I got to go through and do the vision, the future vision for Private Money Club. Because as you all know, Private Money Club it's like a dating site for money. People with money meet people that need money. But right now it's just non-owner occupied real estate. And in the future, it will be a place where people come when you want to buy a car. You want to buy a car, you'll post your car or the car that you're looking at buying on there. Different people will come in and say, I'd be interested in lending on that car. Maybe you got a business startup, maybe you post your business idea up on there and people then come in and maybe they want to take equity positions into that and you raise money for your business startups. It's going to be all those things in the future, but today it's just real estate, which is good because real estate is probably one of the safest, easiest ones to wrap your head around because you all understand it to a certain extent. You all understand real estate to the sense that you've lived in a house or you've lived in an apartment building some point in your life. So you understand how a house works. You understand what rent is, and you understand the metrics of how houses can go up and down in value based on appreciation or depreciation. But the cool part is when you're a lender, there's not really a lot of other things you need to know other than how I do it is when I lend money to people on Private Money Club, and we'll show you some stuff on Private Money Club in a second. All right, so you come in here and you're looking at properties, right? So you can just go to browse deals. So I'm just going to show you how I look at deals and we're going to kind of run through this. So there's been a couple new deals. So like Taylor, I know Taylor well. I've lent to Taylor. Taylor is a partner of Chris Rude's. Okay. This deal is not a Chris Rude deal, but he's a partner of Chris Rude. So I've lent to Taylor and I can show you a whole bunch of the deals that we've lent on to Taylor and Chris Rude, but he's very experienced. But one of the things, the first thing, if you were looking for deals, you're looking through them and, you could kind of go down, you can just get one that catches your attention. Now this one went back on. I thought he got this deal funded. You're just looking for something to catch your eye, but this one, let's just say this catches your eye. 315,000. It was just posted November 23rd. It's in New Orleans, which is a good area. Let's see, seller moved into the house in 2017. So we pull it up and we look at some of the photos, and that's not bad. I mean, some paint, some cool things. Someone should throw those couches in. Looks cool. It's the back. Could use a little bit of landscaping there for sure. So it's got potential, right? And you look at it, great area of New Orleans. You get some information, you scroll down, look at some of the financials. And then right here, after repair value, 440 to 450. So then I would want to know, okay, would you pay for it? So really what I'm looking at is I'm just trying to get a gauge on the property to see if this is even a property I'd want to lend on. So let's just assume that this is one. Now, I think here Taylor did himself a disservice because he didn't really give enough information. And when he first posted this deal, he's got a video walkthrough of it, but he didn't have photos up. So I told him. So the very first thing I'm looking at, let's just pretend I don't know Taylor. I'm really looking at the deal, the location, and I'm just looking at some stuff. But here, he doesn't really do a good job of describing the property to me. I don't have a good metric of like this property. And if I don't have the time or don't want to spend the time, I'm going to actually have to ask him questions. But the second thing I always do is I always go in and I read about the person. Now I know a lot about him, but you can see here, he's talking about, here's the different stuff he's looking to borrow. Here's all the different information about him. The first things I would notice about this particular person is, number one, they've got some longevity in this. Okay. So since then, he's bought and flipped or held 40 houses. That's some experience. He's got 32 units of apartment complexes under his belt. and he wants to do about 50 homes per year, build his rental portfolio, so on. He's got a team. That would be the second thing I would notice. Notice how I'm not underwriting a deal here, folks. I'm underwriting a person. I lend to people, not properties. The property is just what I get if they don't pay me. Outside of that, I really don't give two craps about the property. I just want to control the property, and I want that to be my security. I think a lot of lenders spend way too much time on the property and not enough time on the actual borrower. If you're going to have problems in private lending, it's not going to be with the property. The property's not going to call you up and yell at you. The property's not going to make excuses as to why the deal is going long. The property's not going to complain. It's just going to sit there and it's going to do what it does. It's just sticks and concrete, and that's all it is. Where the problem is going to come is from the borrower. So you want to make sure that you're dealing with a borrower that understands the business to a certain extent. You want to understand their financial picture. So the very first thing I would do, you can see he's the CEO, he's got a COO and a CFO, and we could kind of go deeper into that. That's interesting. Steven, you ever seen that before? I never have. All right, we'll get that fixed. I don't know why that's doing that.
Yeah,
all right, so this has already been sent in, folks. We just got little bugs like this that happen from time to time, but that wouldn't stop you from looking at it. So you can kind of get this whole idea. Now, I already have done deals with Taylor. When I have done deals with him, I just want to show you some things. The first questions that I normally would ask is I would ask them, so I'd want more information. Is the deal funded, blah, blah, blah. And, just ask all the questions. And a lot of times what he's going to do is he's going to send me over the information that I ask him for. So I thought maybe I had it in here, but it was probably done through an email. And once he sends me the information about his deal and about him, I'm going to really focus most of my time on him. I want to know what your finances look like. I want to know his personal financial statement. How much income do you make? I want to know his income. And I want to know how many income sources does he have? He's got a W-2 job. Does he have rental income coming in? Does he have interest coming in from anything else? I like people to have more than one income. If somebody's only got one income, and especially if it's a W-2 income, I get a bit nervous, because what happens if that income shuts off? What are they going to do? They're just going to stop paying me, right? And then secondarily, what happens if things get tough with that property? What if Taylor goes long in fixing that? What if it takes longer? What if something happens to supplies? He can't get them on time. Does he have enough money in the bank, in brokerage accounts, wherever his money is, in IBC policies, to coast for a period of time if things don't go right with the property? You see what I'm telling you is, to be a good private lender, you got to underwrite the person. That's the single most important thing. There's a reason I still lend to the same people I've been lending to for a while. It's because I've gotten to the point where I trust them. I understand them. And because I trust and understand them, I feel comfortable lending to them on multiple deals. So those are just the things I would urge all of you to really focus your time and your energy on, is get good at understanding people. Get good at understanding people's finances. You know what your finances look like. Do a personal financial statement yourself on you. Now, when you look at a personal financial statement, you'll know what you're looking at. And don't ever just take things at face value. If a lender tells you that they've got $100,000 in their bank, their personal financial statement says $100,000. And I'm just going to see if I've got one here. This was a Chris Rude deal. I don't know if this was done with him, but like, they send me the whole packet here. These are just deals that I've funded. I want to know, if they tell me they've got $100,000 in the bank, I want to see it. They don't have to walk me into their bank, but I literally want them to show me bank statements. I want them to show me 401k statements. I want them to show me every single thing that they can to make me feel comfortable that what they're telling me is the truth. And not only what they're telling me is the truth, what they're telling me is fact. Okay. This is another lender. I'll show you because I can't put it up on the screen. This is another lender that I lent quite a bit to. The name of the company is RPG. Okay, they're not as experienced as Taylor or Rob or Chris Rude, but they're hard workers. They both have W-2 jobs. Okay, it's two brothers. Each had good W-2 jobs that they'd been at for a while. They didn't have a ton of savings, but they had enough where they could coast probably 3-4 months. But what they did do a really good job of is of putting the deal together. They showed me everything I wanted to see about the deal. So now I'm underwriting the deal. I've already underwritten them. They basically showed me behind the curtain how much money they have, their income. I've gotten to understand the borrower. Now I'm going to understand the deal. And on here, they're looking at renting this one. So I think think they're paying this one off, or they already did. So with this particular deal, they showed me a cash flow estimator based on renting all 3 of the units. This is how much money they were going to make every month, which I liked, because if they get over the renovation phase, which when I looked at the photos, sorry, these are black and white, there really wasn't much needed on this thing. They could have just rented this property right as it was. The second thing I did when I was looking at this deal is I wanted to see, what did other properties sell for in that area? So this is 162 Locke Street. So when we did this, what they showed me is a comp, okay, comparative market analysis. Here's their property with all the information. They bought it for $46,000. And then here is another comp in West Ave. So if I went on Google and I put in this address, I can see how close it is. And sometimes they'll actually tell me it's 2 or 3 miles, away. So I can see this property, list price 140. Here's another one, West Ave. Now I know this area, so I know these are all really close, listed for 139,000. The only issue with those comps is they listed, they didn't sell. So when we flip it over, they had other deals here. This one listed at 124.9 and sold for 122. This one listed at 120 and sold for 120. These are all 3-unit apartment buildings, just like their Locke Street. So right there, from a collateral standpoint, this comparative market analysis shows me that the property they have at $46,000 they paid for it, they got equity in this house. So if they don't pay me, I'm happy to take this property. I'm not upside down. I'll take it and I'll rent it out and I'll make the money on it. But when you're looking at the deal, those are the most important things. Make sure it's a location that you like. I don't like any deals. I've seen deals on Private Money Club that are like 48 months. I just won't lend on a 48-month deal. Stephen, have you ever looked at any deals that are like 48 months long?
Yeah, I mean, I've looked at them. I haven't lent on them. Usually they're going to be for like a rental or something that a lot of seller financing, where maybe you'll bridge the gap until they finance it or something like that. So they're pretty common. I've seen several in PMC.
So, there's long-term deals, which is great. Like people like Brent love long-term deals because they just want to send their money out to work, and they don't want to get it back quickly. They just want to keep it out there so that it's working. And some of you are probably just like that too. You want longer term deals. For me, because I'm such a wimp and so risk averse, I like short-term deals right now because there's so many things changing in the environment that I just want to be safe with shorter term deals. So I love 12-month deals. Like Cody Sperber, maybe some of you know of him, clever investor. He's got these investments. They're all 12-month deals. I like that. Okay. And Clever's got plenty of money. So, like from that standpoint, that would be a deal I would certainly look at. If someone sends me a deal that's like 48 months or 24 months, I really am not interested unless there's something else to it. You just kind of go back for private lenders. Underwrite the person first. Ask questions. Don't be afraid. Listen, you've never gone into a bank and been, when the banker asked you a question like, hey, can you show me your tax returns? Can you show me your, what would they ask for? Your W-2 statements. They would ask for pay stubs. They would ask for bank statements. They would ask for 401k statements. They'll ask you for everything. Did you ever look at the banker and be like, how dare you ask me for that? That's my stuff. That's not yours. You've always shared it with them. So don't be afraid to ask a borrower for as much stuff as you want to feel comfortable. And if they won't give it to you, or they push back, well, they're hiding something. That's how I always look at it. And I could be wrong, but that's just how I see it. So before I move any further into once I've underwritten the deal and like the next steps, Stephen, what questions do we have? I see a ton of them up here. I don't want to go too far without hitting questions.
Having a trust being the owner of the policy.
Yeah, we've been getting this a lot. I don't know why. A lot of people are saying, should we, open a trust and then have the policy be owned by the trust? So just saying that, having a trust, that doesn't mean anything. There are revocable trust, irrevocable trust. There are so many different types of trusts. There's ILITs. I mean, we could go on just a whole hour and a half just on the different types of trust. So I can't really answer that because I don't know what your needs and goals are. I don't know what kind of trust we're referring to. As a standalone, I typically would tell the average person that you probably don't want a trust to own your policy. The only reason a trust, it's not the only reason, there's tax reasons and some implications, but the main reason somebody would have a trust own a policy is for estate tax purposes. Now, let me look real quick, and then we'll judge how many of you have this. This is a legitimate act. The federal estate tax. So it's 12.06 million right now. So if your estate's worth more than 12.06 million, okay, then you have an estate tax problem. And if it's less, you don't really have anything to worry about from a federal estate tax issue. And you guys don't have to say anything on here, but if any of you have an estate, when you add up all your assets and everything you have, and your estate's over 12 million, and I know this is subject to change, you know, because this government and administration certainly probably is trying to bring that down. But if you have an estate more than 12 million, trust planning should already be part of your life. If you do not have an estate over that, and you don't anticipate your family after you pass to have an estate over that, then you probably really need to consult with somebody different, not just trying to sell you a trust about whether or not you should have your life insurance owned by the trust. And again, that's very general. It doesn't apply to everybody, but just think long and hard before having a trust own your policy. Because remember, the policies that we design, number one, they're tax-free. So some people would say, put it into a trust so that the taxes aren't there. They're already built tax-free. Number two, they're protected against judgments and liens in most states. Trusts are really created for protection. Okay. And like I talked to state tax planning, like that would be protection from having to pay estate taxes. So the trust provides a wrapper of protection, but it also can hinder some of the things that you're going to do. So just think long and hard before having a trust own your policy.
And where I would do it is, you know, like if I have I own a policy on my son, right? So, you know, if I pass and he's either not, you know, of age or even after he's 18, and I just don't want him to have ownership. I want to still control that policy that's on his life. I don't want to turn it over to him, so to say, right? Well, somebody has to own that insurance policy. So having the trust own it, now the trust, you can control the trust from the grave.
Correct.
So now I can put stipulations in there, you know, he can, you know, if it's let's just assume it's a large policy with, you know, say it's $1 million in cash value, you know, maybe I don't want to give that to him yet. So, you know, we can set it up where, you know, once he completes blah, 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 then it becomes his, or it never does, or whatever. And, or maybe you just want, you know, that to stay within the trust for his grandkids. So you can, you know, so there's different ways to use the trust that way, but otherwise what you're saying, Chris, yeah, it gets a little complicated.
Yeah, I agree. But even in that case, like what you just talked about, if you're trying to control the money from the grave, which is really what a trust is very good at doing, you wouldn't so much have the trust own it. You would have the trust be the beneficiary of the policy. So that way, when the policy,
no, because I would still need the trust to own the policy because the policy is on my son's life.
Oh,
He's still alive.
You're
so
right,
I die. I don't. So the policy has to be owned by somebody, right?
I understand. So I missed that part. I was thinking the death benefit. Yeah. Okay, perfect.
No, it's on his life though.
Gotcha.
What is the minimum of money that is needed to start lending in the money club, would you say?
You're going to get some different answers. I've kind of come to the consensus by a mathematical equation, 25,000, but I don't think that's the right answer because you're missing out on building relationships. So let's just say you've only got 10 grand. And you're like, oh, I'm not going to join Private Money Club because I don't have enough money because Chris said you need 25,000. Here's what you're missing out on by listening to me and not joining because of 25,000. You're missing out on over 3,000 members. You're missing out on 3,000 relationships you could start building now before you have $25,000. You're missing out on all the education we're building into the site and all the connection we're building in and all the education that we're building into it. That's what you'd be missing out by not signing up because you didn't have the 25 grand. Steven's corrected me on this several times, and I think I see more from his standpoint. So because I used to always just say 25,000 by the math. If you lend 25,000 at 12%, it makes sense to pay the membership. But if you value your education and you value relationships, then I really think you need to think long and hard about that question as to what the minimum is. I would say the minimum should just be, what is your learning? Yeah, there you go. 20 grand.
What is $20,000 deals in here? You can throw 10, 15 at something as a second investor, but this is the value, the learning platform, and then the connections. I mean, that's where the value is. Even if you have nothing to lend, just for $1,000, which by the way, the site is $1,500 a year right now, but we have a special Black Friday thing still going on. So if you guys want $500 off, just let us know. It's going to go away this week, but we can still get you that discount. So for $1,000, like just for that is worth it, you know?
100%. So that's the thing, you know, I think 25,000 from a mathematical standpoint, but even if you only had 10 grand, you could find deals at 10 grand and you can start building relationships, because over time you're going to build more money. And then, if you wait, I mean, who knows? I mean, we might not stop at $14.97 in terms of the annual membership. So you lock in at least at that price. Another question that came in, and I want to make sure all of you are putting your questions into the Q&A, because it's very difficult for us to answer questions when they're just coming in chats. But Seth R had asked a question that I wanted to hit, and then I'm going to come back over to Q&A. He said he's trying to decipher, why do they use Private Money Club, PMC, versus hard money lenders? HM is 2 points and 9%. Am I missing something? Yes, Seth, you're missing a ton. Hard money lenders, okay? Any of those hard money lenders out there, it sounds like you've dealt with them because you know the rates. They're going to charge points and an interest rate. Now, that interest rate's lower than what most lenders will lend at on Private Money Club, or about the same. But your hard money lender is very much susceptible to market volatility. In other words, when the stock market keeps going down, hedge funds and hard money lenders, you watch, they'll start to freeze up. They'll start to seize up. They'll start changing their lending limits and their lending rules. Maybe now they lend 90% of LTV. In a couple months, it might be 70%. You jump through a lot of hoops. They tell you that they'll lend you X, and then they do their own appraisal and they don't lend you X. They lend you significantly less. Am I true? Is that true, Seth? Have you dealt with that? Because if you haven't, I don't know what hard money lenders you've been dealing with, because I don't know a single hard money lender that when you first go to them and they're like, hey, here's my deal, here's this, they just do their math, because it's a salesperson. You're talking to a salesperson when you get there. They get a commission on that loan when it closes, just so you know. And they want to close that loan. They want to get you in the pipeline. They don't want you to go into their competitors. So they tell you what you want to hear. Oh, yeah, we can do that. And then you feel good. You're like, oh, whew, I didn't think I was going to be able to get the money for this deal. And then like, okay, well, here's the process. We have to do this. Here's the things we need. We got to order an appraisal. They get the appraisal. Probably 98% of the time, the appraisal comes in way less than what you thought your property was worth. And then they will lend you less money. It's a game that they play. I don't care how you look at it, but the reason you use private lenders is that game doesn't exist for private lenders, because it's a relationship. I know you build a relationship with hard money lenders, but you don't build a relationship with an institutional hard money lender like you build a relationship with your neighbors, your coworkers, your friends, your family, and all the people on here. That relationship pays massive dividends. And once you build the relationship, you've got somebody that will continue to keep lending regardless of market conditions, regardless of what their hedge fund backer of the hard money lender tells them. Well, we can't give you this. So they change the rules. It's a much cleaner, much easier process, and the relationship continues to keep paying dividends down the line. So you paid 1 or 2 points more, and you got the money you actually needed to get the deal done instead of piecemealing you like hard money lenders do. I could go on for days. I know so much about hard money lenders because I've probably done, I bet you any money, I borrowed money from hard money lenders, institutional hard money lenders, north of 50 times. So I've dealt with them. I've seen how it works. But if I'm wrong, Seth, if you know one that doesn't play any games, please let us all know.
And even at the numbers he said, I mean, if it's like the other thing with private money is it's a lot more flexible. So depending on what your needs are, you can negotiate with the private money lender and get what you actually need, as opposed to hard money lenders. They usually have a very strict and set loan structure. Like, we will only lend at this amount for this deal. So there's not a lot of flexibility there for what you need. I mean, even at 9% and 2 points on a 3-month flip, 12% flat with no points, you're actually cheaper money at 12% with no points, as opposed to 9% at 2 points. So, something like a quick flip or something like that, it's actually cheaper using private money at the higher interest rate because of that factor. Plus, hard money lenders, I've seen them have, just like banks and mortgage brokers, origination fees and all kinds of other fees that do add up eventually, onto your bottom line. But all right, so kind of two things here we might be able to combine. So which is better, investing in an index annuity or a whole life insurance policy?
They're not even the same animal.
Right.
You're comparing a skunk with a kitty cat. I mean, maybe they look cute, but the skunk probably isn't going to be as good of a pet as a kitty cat. It's not even a good analogy. I can't really tell you. You can't pick one or the other. They're totally separate in what they do. They're not even created to do the same thing. I hate indexed annuities. They're tied to the index. And if you actually have looked around indexes, S&P 500, Dow Jones, they're negative 20+%. and going south, not north. So if you're tied to an index in some way, they're like, that's what you're relying on, is the market's going up, not the market's going down. So an indexed annuity is terrible, but variable annuities are market-based 100%. So they're terrible and they're loaded with fees. Fixed annuities I like for the right application, but you got surrender fees, you got tax rules, because even in a non-qualified annuity, fixed annuity, you still have early penalty fees for taking money out because it's a tax deferred vehicle. There is no other vehicle that you can compare or can compete with life insurance because of the tax treatment and all the things that the whole life does. Then you design them the way that we do, the specially designed and engineered ones. Now you've got something that actually can work as a banking system for you. That's kind of a weird question. I would urge you to watch a couple more videos, or maybe just jump on a call with us so we can really talk about like what your needs and goals are, because I don't know what your goals are. If your goals are like retirement, you have money that in an old retirement account, you're looking to roll that money over, maybe a fixed annuity makes sense, or I still don't think an indexed annuity would, but maybe. We just don't know your needs and goals.
So the main concern I have is, how does this system help nowadays with the cost of living and inflation being and getting higher than the interest rate you gain from the money you put into the policy?
You have a lot to learn, Chris. If you think that what we're talking about is the money that you earn on the policy, the 5 or 6%, you're missing the entire concept that we teach called the infinite banking concept. So Chris, let me just frame this up to you. Let's just say the policy pays you 5 or 6 gross. Okay. But then you take the money out, you got 90% access, like that one I just described. You put 100 grand in, you take 90 grand out. You're still making 5 or 6% on the full amount of money that was in your cash value. Okay. Which we'll just call it 100 grand. So then we take 90 grand out and you lend that 90 grand out at 12%. How much money did you just make? Okay. Did you make more than inflation? 7.7? Yeah, you're making 10 or 12% lending it out, but you're still making the spread between what your policy pays and what you're being charged in interest. So that company that I said, so let's keep the math simple. 5 is what you're making, and all of them pay more than 5, but let's just simple. 5 is what you're making and 4 is what you're paying. What's your spread? 1. And then the money went out to make 12. How much did you make? Did you make 12? No, you made 13 because you made a spread plus the 12. That's all more than inflation. We don't do what we do, Chris, to make the interest. I mean, the interest is, let me pose the question to you a different way, Chris. How much money are you making on your savings account, your bank account? Is it 1%, 2%, or maybe you're making 3%? Would you rather make 4 or 5 or 6 on that money? If your bank would pay you 4, 5, or 6, would you say, no, I'm okay just making 2 or 3? No, of course you'd be like, yeah, pay me 5 or 6. That's the difference. There's only a couple places you can store guaranteed safe money: bank accounts, money market accounts, checking savings accounts. Especially designed and engineered whole life is guaranteed. No ifs, ands, or buts about it. Guaranteed. Already right out of the hole from the pure baseline, it's better than where you can put your money now. So when you say it doesn't beat inflation, neither does your savings account, man. So then if you just put the money in the policy and you do nothing else, you didn't follow any of my teachings at all. You didn't follow anything we teach, because what we teach is not to put money in a policy. And actually, I don't know if anyone else wants to comment on this. Did we ever teach anyone just to buy a whole life policy and put the money in there and just leave it alone? Does anyone ever heard me teach that? We teach you to put the money in and then send that money out to work, because we understand that when the money hits that account, that whole life, it's earning interest and dividends. And when you take that money out, if you build it on a non-direct recognition company's platform, when you take that money out, you didn't affect the interest and dividends you were earning. That money that you took was the death benefit being advanced to you. And then that money goes and makes money a second time. So Chris, what we teach is how to make money twice on the same dollar.
And even if you didn't touch the money, after the first few years, if you look at this like a bit like a savings account, let's say, you got to save your money somewhere. So right now you're saving it in somebody else's bank. But what if you started saving it in your bank today? Now, it's not going to happen overnight, but within the first 5 years, your money that you're putting into your bank, that whole life policy, will start to grow at a rate greater than inflation and everything else out there. Because what you're looking at is okay, it's growing through the dividends, 5 to 6%, inflation's at 7.5%. How does that add up? But that's just looking at the beginning. Because of uninterrupted compounding interest, the policy becomes much stronger. So can I just give one example, Chris?
Oh yeah, thank you. I was actually just looking for one.
Check
Thank
this
you
out.
so much for doing that.
So check this out. So this is a whole life, is what's called an illustration. If you're new to us, this person, you can decide how much you want to put into it. I'm just gonna use this as an example. You put whatever amount into this as you want to, but just using this, look in the 5th year of this. Okay. They put $50,000 into their savings account. All right. But look what happens whenever they put that 50,000 in. Their account grows by $56,595. So if I do the math on that, that is, when I put 50,000 in, that's $6,595 in growth. Is that correct? So if I take $6,595 and I divide that by the 50,000 that I put in, so 13%. So your money grew by 13% in the policy that in the 5th year. Now let's look at what happens the next year. The next year we put $50,000 in, the policy grows by $9,985. If you want to do that math real fast, we take $9,985 and we divide that by the 50 that we put in. That year, our money had a 20%, 19.97% growth. Look at this. I mean, each year, it just more and more and more and more for the rest of your life. Now it drops down there to 45,000, but look what, we only put 17,000 in that year. So if you want to do the math in the 11th year real fast, I mean, that's
going to be a lot, because that's when we drop the term off.
300%. I mean, so even with that, even if you never touch the money and you're just saving, do you see how this is growing and outpacing? And now incorporate the infinite banking concept and being able to simultaneously take that money out and use it for investments and lending and everything else out there. That growth that you see is happening in that policy, whether you're using the money or not. It doesn't matter. That's why we use non-direct recognition companies, and that's the power of these policies. So forget about the infinite banking for a second, even Chris. Even after the 4th, 5th year, your money is growing way, way more than what inflation is.
Yeah, I think I was just making the point that we never teach people to put money in the policy.
Sure.
Now, that wouldn't be bad. I mean, you guys just saw the numbers. That wouldn't be bad for that, but that's just not what we teach. We teach the infinite banking concept. We don't sell a product. We just use the product. We use the machine, as we call it, the specially designed whole life, to keep that money in motion and keep it working for us. Remember, end-to-end control, like I explained, the Monopoly game, just trying to give you all these things, these visuals. Let's hit Tanya's. I like her questions. As a lender, do you have a prepayment penalty? Absolutely. All the time, every deal. I don't care what deal I grab. I'm just going to randomly just grab one here. 348 Juniper Drive in Freeport, Florida. Here's the note. Let's see, the prepayment penalty, and they're all different. So this one is a $735 prepayment penalty if paid off within the first 30 days. I've seen them all different ways. I've seen them as high as like $5,000 for an early prepayment penalty. And then I've seen them with no prepayment penalty. It really depends. But if I'm going to go through the work to underwrite a deal, I want at least my deals are all 2 months worth of interest. I don't care if you sold the property in the first 10 days, because I don't want someone borrowing my money. They've already got the deal sold. They weren't honest with me. The deal sells and they said, well, here's your interest. And I get a check for, $400. That's not worth my time. So I would urge you to put prepayment penalties, just pick and choose what you want. I like 30 to 60 days bare minimum. If the property's sold in the first 30 or 60 days, however you want to do that. So we're getting a lot of this stuff about digital currency. And you're right. Are we going to be going digital currency? It sure the hell looks that way. It looks like, we're going to have a centralized digital currency that's going to happen, especially with this FTX thing. They will use that as a catapult to push their agenda for that. And when they do, Tanya, I hate to say it, there's nothing any of us can do about it, because you live in this country. Whatever the currency is, that's what we have to use. That's the means of exchange. Right now, it's the green bills, right? The dollar bill.
I mean, currency's digital now. How often do you actually use cash? It's done through wires, it's done through checks, it's done through online payment systems. I mean, the digital currency thing, it's more about tracking and control, and okay, we can shut your account off just like that. But technically they did that to the Canadian truckers. I mean, they shut them their bank. I mean, so to me, it's not that big of a thing. I mean, no, I will fight against it and don't want that. And I think it's going to lead to terrible things. But from a financial standpoint of, is it going to kill you financially? It's not going to hurt anything. I mean, we're all going to be in the same boat. It's not going to be you're specifically, and money's still going to be invested the same way, and everything's going to be done the same way. But that's the argument for Bitcoin, right? A decentralized digital currency. So I think that'll be the battle.
And there's a whole bunch of crypto founders and, experts. And so far, I think we know of 4. They're all dying. They're just, drowning, at 29 years old, dying in their sleep, helicopter crashes, things like that. So miraculously, all the free thought leaders in the crypto space, they're just dying. I don't know. And it's not even from things that you would think that a 29 or 30-year-old would die from. I want you to think about that and understand what's going on behind the curtain there. But you're right. If digital currency is going to be what we transact business in, there's nothing I can say about it, nothing that will change anything that's going to happen. And all dollars that go through whole lives, your brokerage accounts, your 401k accounts, your paychecks, when they go to digital currency, all of it will be done digitally. It will. You're already doing it digitally. You guys, I had somebody the other day, I was snowboarding and I got done early. So I sold my pass because I've spent $97 on a full day pass and I only rode for 3 hours. And walking out, I saw these young guys in cool snowboard outfits. I said, hey, you guys, need a pass. And they said, yeah. And, I offered it to them for $30. And the guy's like, do you take Venmo? And I said, no, of course I have Venmo. I said, no, I don't want Venmo. I'm trying to fight this. I'm not trying to play into it. His buddy's like, I got $30. So like cash is still king. And don't forget that. I could do a whole training on like how much we're hurting ourselves by continually paying with credit cards in these digital payment forms, because every one of those digital payment forms has a little fee attached to it. If we exchanged $100 to buy things, and that $100 we paid for our dry cleaning, and that dry cleaner took the $100 and bought groceries, and that grocery store bought gas, and that it's still $100. It's $100 transacting around. Forget about inflation. It's just $100. If we go out and we do the same $100, but we put it on a credit card, that dry cleaner has 3% less to use because of the credit card fees. Then that money goes to the grocery store, uses a credit card, 3% less, 3% less. Track that as many times. And then eventually you don't have $100. Eventually the amount of money in circulation is far less than 100. And the only one that won is the credit card. And who's the credit card? The bank. You got to really start thinking about what you're doing, because we are the problem. So Tanya, to digital currency, why is digital currency going to happen? Because we allowed it to. That's why.
Chris's question is pretty good, actually. He's talking about funds.
Okay.
So can you spend a minute explaining what the due diligence should be on a fund versus like a private person? You've been talking about you want personal financial statements and underwriting the deals and that kind of thing. I sent both the Rob Fuller and the Inicio fund to my attorneys, and they both said there's nothing specific in the paperwork, and it comes down to just trusting the people that are running the fund, etc. There's no recourse if the fund folds. How do you approach lending to a fund to be sure your money is secure?
It's a freaking awesome question.
Yeah,
And it's
really
an awesome
is.
question because I just did it this morning. So I just got a new fund sent to me. It was Cody Sperber's fund, Clever Investor. And I'm literally trying to find the email that I just sent. And I will, if you can give me just 1 second, Stephen. This is a very important question because he sent it to his attorney. First thing he did right. What did Chris do right there? He didn't try to make a decision. He sent it to
Christine.
Christine, sorry. Christine sent it to her attorney to review it. And her attorney came back and said, really nothing, specific in here. Do you know the people? So I I got to find this.
I actually read the email from the attorney that they sent to Chris, and it was good. I mean, it's kind of just what we're saying. Yeah.
So they sent me the PPM and the subscription agreement, very common things in syndications and private funds. I said back to them, I said, the positives are it's a 12-month offer, which I have people looking for short-term deals, and they've been the most popular on Private Money Club. I also, and then I said, you also have to August 23rd, which gives time, blah, blah, blah. I said, is this fund always going to be first position for all real estate that the fund, has? So first thing I asked is all the real estate deals you're going to do, are you always going to be in first position? Then I went on and I said, how does the fund value the real estate? And what I'm saying, I really would like that to be a third party appraisal. I don't want to hear, oh, we do BPOs or we do comps. No, I want appraisals. So these are all questions I sent over to their lead on this. I said, the real estate market is dropping and will continue to drop. So how do you plan to exit these properties to pay investors back, specifically the 12-month offer? How will liquidity be created if market prices go down, banks freeze up, and they limit lending? Okay, that was a question. Then I said, this will happen likely in the next 1 to 2 years. So how do you plan to mitigate that market risk? And then I went on. in the PPM, like, so it's Cody Sperber's Clever's fund, but they mentioned Green Elephant. Now this is like a third party. I said, who is Green Elephant and who owns that? I said, what are their financials and are they available? So what's this Green Elephant company? Who owns it? And send me their damn financials. I want to see that. I want to see behind the curtain. If they're going to be the sort, because it sounds like this fund is lending money to Green Elephant. So Green Elephant's probably the operator. They're lending money to Green Elephant. Green Elephant's going out and buying these short-term rentals. So my next question to that, this is just me reading the PPM. I said, if they're the source of the liquidity, that's important to know what assets they have. It appears that this fund is going to be a pass-through to Green Elephant. Am I correct in this assumption? I'm looking to understand the risks specifically. So that's kind of my email that I sent to them. Essentially, all I did in that PPM is I just read it, just like your attorneys did, but I found inefficiencies in there are just things that, hey, you're saying you got a 12-month, a 24-month, and a 36-month option. Great. How do you create liquidity for that 12-month option? How do you create liquidity for that? And then if the answer came back, which are going to be the standard answers, well, we're going to sell the property. Great. What if property values drop 20 or 30% and you can't sell it? Where's the liquidity coming from? Okay, well, then we would rent it out and we would refinance it. Okay, what if the bank isn't lending? Where are you going to get money? What I'm actually looking for them to say is, well, we would go to an institutional lender or private equity and we would take out that series, which was Series A, we'll take out that series of the private fund. Sorry I went long with that, but that is just a really freaking good question. Just read the PPM and the subscription agreement, and then start asking the hard questions like, okay, great, you're going to pay 12%. That's pretty easy to justify how you're going to do that. But if you're going to pay me all my money back in 12 months, how are you going to do that? That's a legitimate question. What is the money being used for? And what is the security instruments that you're going to have for this fund? That's another really good question. If there's more names in there, ask for information about that. Our fund, Incineo, like there's a brochure. It has all the partners in there, and all those partners I know for a fact would share their financials if you asked for them. So I know what we do with our funds. Therefore, I know how to ask the right questions to other funds, but not everybody does. Some people just take it at face value, which I would urge you not to. And I love that Christine sent that over to her attorney. That's the first step.
Should an average income person who has less than $1 million have an asset protection trust? And I would say get with an estate planning attorney about that.
Yeah, that's a loaded question. From face value, I would say it definitely wouldn't hurt, but it depends on where your assets are, and it depends on what your assets look like and what your goals are. So again, that's more of a legal question or an estate planning, professionals, but that could go both ways. I from the surface, I want to say no, but again, I just don't know what the assets are.
Life insurance companies that we use, best for banking.
It's not just what best companies there are, it's what your needs and goals are, Seth. So really what we do is we find out more about you and what your needs and goals are. What are you going to use the money for? How are you going to use the infinite banking concept? And that will usually drive us to a specific carrier versus one or the other. But just to kind of lay them out, you would have companies like One America. You'd have companies like Lafayette Life, Guardian, Penn Mutual, Security Mutual. Who am I missing in there? Penn Mutual, Guardian, Mass Mutual, but we don't use them anymore because they don't want you taking loans in the first year. And sorry, that just doesn't fit our business model. So we just, we don't write for Mass anymore. They're a great company, but they just changed up what business they want. And I guarantee you they'll be begging us to come back later.
All right. The cost of PMC is $1,497 a year, $1,497. But like I said, we do have one last week of a discount here with $500 off. So if you want to get it for $997 a year, and that would lock you in for $997 a year for at least 3 years. I would recommend doing that this week. It's privatemoneyclub.com, and you can do it right on there, or you can schedule a demo call if you want somebody to walk you through it first and help you get signed up. And I put that link right in the chat box also. And that's for Deborah and Ton, both asked that question.
Oh crap, forgot
right.
the space.
New investor with seasoned contractor builder, have a startup, fixed flip, short-term deals. Should we use other sources of lending to build a portfolio before posting deals on PMC to gain trust?
Hell no, Carrie. Like right in there. Like, I love it. You're new. So first thing, strike one, but then you said seasoned contractor. That means you're not new. Like that actually gives you a higher credibility than even just somebody that's flipped a couple houses. So seasoned contractor and builder, like already I've got instant trust because you know how to build and you know the hardest part about this business, which is the contracting part. And then startup, fix and flip. And the second thing I said that you loved is short term. Like, love it. And you can control that better because you understand the contracting part. So no, you should not wait. Not at all. We need more people like you.
Foresters. What about foresters?
Foresters works, but I haven't seen any policy designs that I like. They're one of the companies that certainly works, but I haven't seen a single illustration from Foresters that actually excited me. They're kind of like Security Mutual, which we don't really do much with. It's a good company. I have a Security Mutual policy. I've had it for a long time. It's decent, but it's nothing like the ones we build with One America, Lafayette, and some of those other companies.
Oh, referencing the digital currency question. I mean, yeah, I mean, real estate, where else your wealth? I mean, if you sell it, it comes back to digital, if you keep it. And I mean, I'm a fan of that. I mean, real estate, and then, obviously precious metals would be a strong hedge against the digital currency because they are physical. Now you'd want to probably take possession of them. If it's stored in vaults or offsite vaults, they can be protected, but the government's all powerful. So what if they wanted to go in and raid those vaults? Could they do that? It's happened in history. So why couldn't they? So I would say warehouse those and be very protective of them. If your goal is to buy those, for the doomsday worst case scenario type thing, right?
Yeah, I like that. And you're going to see 10, you're going to see a lot of people do that. When we do go to a digital currency, I mean, we've just gotten so used to this fiat money that it's just the norm now. But once we go to a digital, I think you're going to see a lot of people convert digital currencies into hard assets, just for that safety. I would be one of them. And I know Steven's already doing that. So it's a smart thought.
Is there a difference with setting up policies if you're planning on using them for more banking and not needing as much legacy?
That's all we do, Paul. Like I promise you, if you came to us, Paul, for a policy with a lot of death benefit, you'd be really upset. I just did a call with one of our really good clients the other day, and we went through this. Like, the death benefits on the policies we design is significantly lower than a regular life insurance policy or regular whole life insurance policy. And that's by design. Because if you think about it, the cost in a policy comes from the death benefit. The cost of insurance is the largest drag on a policy. That's the highest cost. So what we do is we build them with the lowest death benefit, the highest amount of cash value. So it's the complete opposite way your insurance agent or your advisor would design your policy. But that's why they work for banking. So Paul, I would just say, jump on a call with us, watch the 90-minute video and jump on a call, because that's only what we do is build banking policies. That's it. We don't do regular life insurance.
Michael said he's waiting on Horizon to say they've received the funds for his SD IRA so he can use it for PMC. And just to address that, Michael, when you request money from another brokerage, like a Fidelity or Morgan Stanley or a financial advisor, remember, when they send your money away, they no longer have that money to make money off your money. So they're going to delay that process typically as long as possible. Now, Horizon has some little tricks to get the money quicker than a lot of other custodians and people will, and they're very on top of it. But so I can promise you they're getting it as quickly as they can, but it's wherever it's coming from that causes those delays. And again, they don't want to give that money up. So they drag their feet and make it complicated a lot of the times. That's very common to see, Michael.
Yeah.
Let's see. Anonymous said, do you need to set up an LLC to loan through, or is it okay to loan as an individual?
It's okay to loan as an individual. The only reason you would really loan as a LLC, the only advantage is, you can write things off. So in the entity, you can kind of write off different expenses that you can't do personally. So if you're lending individually, you guys just got your regular tax return. And I mean, you're just going to pay a higher tax rate more than likely on the money you earn on lending. Through an LLC, you can do all sorts of different stuff, get with your tax professional or a CPA to kind of teach you and look at the advantage or disadvantage for your situation. I want to hit Lanita's question. Pemberton, I believe it is.
What do you do when a mutual company won't allow policy loans for 1 year? Can someone in the group give me a personal loan to pay debt, which is what I plan to do with the policy loan? Goal is to get commercial real estate with policy loans and grow business after debt's paid.
It's not about the mutual company that allows you to take the loan. So it's not all mutual companies like New York Life or Northwestern Mutual. It's not just because they're a mutually owned company that pays dividends that allows you to take a loan in the first year. It's how we design them. It's literally how we construct the contract of the policy so that it works for what we do and gives you immediate access in the first 30 days of opening the policy.
What company is it? I'm just curious.
I don't know. Lenita, in the chat, can you just kind of give us a little more info? What company is it? And is it just a regular whole life that you set up that would make that? So, and then
to answer their question though, you can get a loan. It's called a CVLOC. It's a cash value line of credit. So you can go to a bank and it's Mass Mutual, Chris. So you can go to a bank and get that set up.
Did we design that Mass Mutual plan? If we did, just take a loan direct from them. I know that, they told us not to take loans in the first 12 months. Forget about that. Just take the loan if the money's there, if the money's available. If it's a regular whole life that an advisor or an agent set up for you and you just don't have any cash value in there, you could probably find a bank or a private individual that would lend money to you based on, the future value of the cash value. I know a lot of people that will lend using a collateral assignment. We've had several people do that where somebody needed money and they had cash value, and what they did is a collateral assignment. Kind of, instead of real estate being the collateral, like the security instrument, the policy becomes the security instrument. And then it's probably one of the safest things you could ever do, because if that person doesn't pay you, you have a collateral assignment against that cash value, and you could force all sorts of things to happen with that. We did a whole fund around that. And someday when people start passing away that are the people on the policies, like a lot of investors are going to make a lot of money on that fund.
Just a little bit about the taxes on lending, Chris. Do you report the lending as interest, dividends, or Schedule C?
So the lend, like, what you mean when I lend money? How do I report it? When I lend money, the borrower should, and most all do, send me a 1099. So a 1099 INT, so it's interest. So then I would basically submit that. And if I lend through the entity, then it just comes into the entity. And then from there, we spend money on marketing and staff and traveling. And we try to make sure there's not a lot left at the end of the day. But if it's an individual one, yeah, it's going to be probably 1099 INT, which is highly taxed. But hey, I have never met anybody who's making a lot of money complain that, well, you got two options. Either number one, don't make a lot of money and pay less in taxes, or make a lot of money and pay a lot in taxes, and then figure out how not to pay money in taxes by following the IRS tax code.
Yeah, Sam was just saying, I have a high 9-figure person that I deal with who already has his own money guy. How would you, like a financial advisor, I assume, how would you recommend that I broach a subject with him that I think his insurance plan might not be up to par? He is not likely to listen to my opinion, given my own success compared to his.
Yeah, he probably won't, not because of your success versus his, but probably because he thinks he knows what he doesn't know. Try to get him to watch one of the videos. Like Stephen was playing one of the what now, what next videos. There's another video that I did. I think it's BYO Bank. It's a what now, what next. It's very entertaining, very informative, and all fact-based. Have him watch that video. If you can't get him to watch a video because he's literally that arrogant about it, then just let him lose all of his money in the stock market that his advisor put his money into. And then he'll come crying to you saying, hey, didn't you say you had a place where I could put money that's guaranteed and earns a good interest rate and dividends? Don't worry, because a lot of the people that are all preaching IULs or preaching stocks or, indexes, mark my word, they're going to be calling us. They're going to be calling, asking us how they get to be part of this, because whole life doesn't get affected by the markets. Matter of fact, in this environment, whole life stands a really, really positive chance of seeing an increase in dividends because interest rates are going up. As interest rates go up, yields on treasury bonds goes up, which means the insurance company makes more money on their spread, which means they pass those profits, but they don't call them profits, the return of premiums unused, down in the form of dividends. It's a pretty badass way to do it. I didn't get into the IUL thing, but I still can't believe people are talking about IULs. I think they haven't been looking at their statements, or they haven't gotten their statements, because once they start seeing their statements and they start comparing their original illustration, which had a hypothetical 6 or 7%, whether it's uncapped, capped, whatever version they took, there's 50,000 different variations, it seems. And then they start comparing it to where they're at now. And they start saying, wait a second, I was supposed to have this much and I only have this much. No shit. Excuse my language. They showed you a hypothetical. And if you don't know what that word is, go to the dictionary or Google and just Google hypothetical, a hypothetical return. And right now, this entire year, not one IUL, not one, has performed as illustrated. We've got a guy, Chris Kirkpatrick, who he does what we do. He's, some would say he's a competitor, but he's a friend of ours. And he comes from the IUL space. He was one of the big producers of IUL. And then he started asking questions and looking behind the scenes. He no longer does IULs. He teaches people all about them. He did a challenge. I think it was $1,000 to anyone anyone. He put it out on social media to anyone. He'd give them $1,000 if they can show an illustration. I think he said longer than a year, a year older, that has outperformed what was illustrated, and he'll give them $1,000. Does anyone think he's paid $1,000 to anyone yet? No. And what did we just come off of? The longest bull run in history. And not one person can show him an illustration that is or show him actual performance that has outperformed the illustrations. Folks, wake up, smell the coffee, because that whole world is going to come crumbling down, just like the VUL world came crumbling down in 2008. I witnessed it, I watched it, and I saw how it happened. IULs are going to do the same thing. But whole life, well, that boring, stupid thing that nobody likes will keep doing exactly what it's supposed to do every single time. And chances are we're going to be showing illustrations in the future showing better than what the illustrations are that we're showing today.
All right. So the last thing I wanted to talk about is we only have 5 tickets left for the Mastermind in Mexico coming up at the beginning of next year. So maybe we can just kind of hit on that real fast, because I think it's been a great discussion today. And you can kind of see, when you start surrounding yourself with the right people, get your brain thinking the right questions to ask. And then those questions have answers that lead to your mind thinking about other things that you can do. And so, I love the discussion we had today on Wealth Webinar, Chris. We haven't done this in a while, where we just did more Q&A and kind of just
cool.
Talked about it freely. It was really good. But just imagine that for 3-4 days with very high level people that are, very, very successful. And we're all just hanging out and brainstorming and taking our business to the next level, and then mixing in some good food and some good drinks and some fun activities and some true experiences that are once in a lifetime. And that's what the Mastermind experience is. And it's we've been doing it for a couple of years now, and I think we've honed it in pretty nicely. And I think that the one that we're doing in Mexico is going to be the best one we've done yet. But it sells out at 25 people. We only have 5 tickets left, so I would get your tickets now.
Yeah, and just so you all know, Mexico doesn't do it justice. Me and my wife bought a place in Mexico many years ago, in a place that I would call the closest thing I've ever seen in my travels to paradise. It's called Azul Fives. You can look it up, Azul Fives, Playa del Carmen. There's more pools than you can count. You get your own butler. Okay. So the second you get picked up at the airport. So, you come out of the airport and, in Cancun, you don't really speak the language. Somebody's got your name. You just get in a black car and it takes you to the place, and it's totally secluded, very safe. You go through security. And then as soon as you get out of your car, you meet your butler. Your butler is your butler for the entire trip. Whatever you want. If you want your fridge stocked with Fiji water and a specific type of beer, maybe you only want Corona 0-calorie beer, your fridge will be stacked with that. They will book all your appointments for restaurants and anywhere you want to go. They will take you where you want to go. If you want to go from your villa to the beach, great. If you want massage, if you want everything, they're your personal butler. Like that's what they do. Not only that, so outside of the pools and the beauty, there's a grove you can walk through. Yeah, Stephen's going to pull it up, a grove where you can go see monkeys and all sorts of animals. You're high up on kind of like a bridge that goes through the grove, but it's really cool. You go from like beach to forest, and then you're back in paradise. That's the center thing there. This is the resort here. You can see just pools and pools, beachfront, infinity pools that kind of overlook into the beach, into the ocean. And this is where we're doing our event. So all the conversations are going to be done either on a beach, at a pool, on the rooftop of the penthouses that we've rented. Every one of those, see these pools here, those like narrow pools. A lot of, I don't know if there's going to be any more, but there's swim out units that we had. They might all be taken now. You literally just open a slider and you're in the pool. That's the 2 infinity pools that are at the beach. You're just kind of overlooking the beach. That's just restaurants. That's some of the walkways to go over the different pools. I mean, it's like endless pools, and the rooms are just insane. The water, there you go. That's the ocean, is crystal clear. This is where we're doing it. It's at, Azul Fives. We're doing it here. It's gonna be 3 days of paradise, but 3 days of paradise, having just unbelievable conversations, just like we did today. And we've got a whole bunch of experiences planned. So we're not going to just be sitting poolside. We're going to be going doing some cool things. Like we're going to go to Tulum and see the ruins. We got a boat trip for those of you that are okay. And if some of you don't like the boat, we'll have secondary excursions. But we always believe that the best way to build relationships and to meet people is to go do cool shit with them. So we've got a lot of cool experiences that you're going to go out while you're talking about all this stuff. So 5 tickets That's all there is left. You guys can grab them. We'll put the link up in there. Don't wait, because literally, like, we're not just saying there's only 5 tickets left. There's literally only 5 tickets. Yeah, Kelly Cardenas, I know a lot of you have seen him speak. He'll be there. So you'll be able to hang out with him and his dreads and just have really cool, deep conversations with him. Let us know if you're interested just by clicking it. The cost is $5,000. So the cost is $5,000. So the $5,000 includes everything except for your flight. That includes your room, your butler, all your food, all the drink you can drink, because it is an all-inclusive. So there's tons of bars. I mean, there's a tequila only bar. There's another really cool bar that I love because they serve popcorn. I just love popcorn. And there's just everywhere you go, there's a bar or a restaurant. There's sushi restaurants. There's Thai. There's French. There's the buffet. There's Shake Shop. There's a beautiful Italian place, just an American food place on the beach. There's like certain days they have like lobster and crab spreads that they do that you can buy at the beach. That's not included because that's extra. But everything's included. So it's $5,000. If you want to bring a guest, it's like $7,000. There are payment options because it's not till April. So you can set up a payment option, do 2. I think there's still time for 3 payments. So yeah, I don't know why you wouldn't go if you want to get really ahead of what's happening right now. And that's going to be the best way to do it. There we go. So $4,993 is a single ticket, 2 payments, 4 payments, and you can get a ticket for you and a spouse or you and a business partner. It's kind of buy one, get one half off. So $74.89. Yeah. So there's all the breakouts right on the site. So yeah, join us out there. It'll be cool. You won't regret it. Anyone else here? So there you go. Teresa's saying the experience is amazing. I mean, this will be by far the best one. Well, I apologize for starting late today, folks, and the tech issues, but to be quite honest, I kind of love how this went. How about you, Stephen?
That was awesome. I loved it.
Yeah, the Q&A, like, you guys were great. I want to thank every single one of you for the questions. I mean, you sort of just really good because we got to really serve you more than us just kind of teaching. But not only that, it really helped me just because I didn't know what I was going to do, and just showing forms and stuff from a giant binder really wasn't my idea of how I wanted to do it. So I think it went a lot better.
Yeah, and just to clarify, Elsa, you do not need to have a policy or anything else to be a member of Private Money Club. So you can join Private Money Club today, and then we can get the policy started whenever you're ready for it.
Yeah, definitely a lot more calm. Yeah, if any of you want any of the BYOB hats or shirts, you can just go to chrisnaugle.com. There's down on the first page, there's a little place where you can get any of the shirts that you want. I think the hats you have to buy direct, so you can just email. You can just email any of us, Chris at the Money Multiplier. You can email me and I can set up a hat for you. Just pay with PayPal, or, don't mail me cash, but you can mail me a check. And that way we can just say, screw you, digital currency, because we're not going to be able to do that for very much longer. Azul, AZUL, the 5s. Now they have a couple places, so make sure you look for the beachfront one in Playa del Carmen, because they have one down by Tulum that they just did that's really small that I've toured, and then they have one downtown Playa del Carmen. So Azul 5s, Robin, is the one, but make sure you do the beachfront one. And you'll know when you look at the photos, it's the one with the massive amount of pools. The other beachfront one that they have down by Tulum is just a single unit with one set of pools in the ocean. So ours is way better. Well, folks, thank you all for joining us for another wealth webinar, and we'll see some of you this afternoon at 4:30 for Ask Me Anything. Until then, I hope to see some of you soon, like this afternoon, or we'll see some of you poolside at Azul 5s in Mexico. Until then, have a good day. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.